Hey, what's up guys, welcome back to our channel. So I want to do a quick update on what's going on in the market. Obviously the Ukraine-Russia crisis has gotten a little bit worse over the past few days as Russia for some reason continues to build up their troops on the border of Ukraine. Now this geopolitical news obviously is exaggerating a lot of the sell-off that we're seeing in the broader markets today. I mean, on average, a lot of stocks are down like 5, 10, 8, 20% today on basically no news apart from this geopolitical mania, which in my opinion is again creating a great buying opportunity for long-term investors. But obviously if you're more of a short-term trader, then right now is definitely a very painful time in the market. And this is actually a big reason why I suggest that people slowly buy as stocks are going down instead of trying to find the bottom and trying to go all in whenever the market reverses. Because we are never going to figure out when the market is actually going to reverse. Instead, we're going to see moves like this where arrival is down like 40% in the past 4 to 5 trading days, which is absolutely ridiculous because essentially the stock is pricing in a bankruptcy, which obviously is not going to happen with a company that's trading at a $2.3 billion valuation and has a decent amount of cash on the balance sheet. Now, I definitely think that the Ukraine-Russia tensions are definitely something that the market is right to price in because that geopolitical tension could definitely have some big impacts on US supply chains and particularly on the oil side of things for Europe, because if there's any sanctions that are introduced by NATO or by the United States, then there could be some pretty severe consequences for the Russian economy and Russian trade. And as we all know, Ukraine and Russia are some of the biggest oil exporters in Europe, and that could certainly have a pretty big impact on oil prices. And as we all know, oil prices directly correlate with energy prices, and that could definitely result in a big movement for energy stocks in the United States, which itself is going to have a big movement on the S&P 500 index. And to add fuel to the fire, we also had the PMI rating come out earlier today, which actually came in at an 18-month low of around 50.8, which is much lower than the 57 that we saw in December of 2021. This index is essentially the Purchasing Managers Index, which is very similar to the CPI, except that it focuses strictly on supply chains in the US. And as you guys can see, we've seen a very steady decline in this index ever since October or November of 2021, which is most definitely driven by the Omicron variant. And the big problem is that it doesn't matter what variant you really get, whether that be Delta or Omicron. If you get COVID, you often have to call out of work sick, and that's basically what's been causing the supply chain problem. Now, we'll see what the CPI report says early next month on February 10th, but I generally don't expect it to be too hot because of this PMI index. But the good thing is that we are seeing an inflection point in these COVID cases, which is very typical to what we saw happen in 2020 and 2021, where after the winter and going into January, we saw this nice inflection point where COVID cases already started to go down, which tells me that right now could be the peak in the amount of COVID cases we're going to see, at least for maybe, let's say, the next 6 to 8 months. And that should definitely reflect somewhat in the market recovering, because as we all know, as the stock market went down, COVID cases actually went up significantly, and right around this November to December timeframe is when the stock market really started accelerating to the downside. And it definitely seems that algos or hedge funds keep track of COVID cases and they keep shorting as COVID cases go up, because as COVID cases go up, obviously that affects supply chains and that affects the amount of economic spending we see in the economy. But I think that can turn out to be a bullish thing going into March as the Federal Reserve raises interest rates, because it's pretty clear that over the past year or so, the stock market is essentially projecting forward and it's looking ahead maybe 12 to 18 months. And right now, the market is essentially trying to price in a very aggressive interest rate hike and a very hawkish Jerome Powell, which we all know is going to happen. But at the end of the day, rising interest rates are not going to affect stocks that much, because they're only expected to go up by around 25 basis points in March. And as we all know, this interest rate hike is expected to fight inflation, which obviously has caused this big sell-off in stocks and this big valuation correction in basically every growth stock. But again, that relief is something we might start seeing happen at the end of February and at the beginning of March. But as for right now, the IWM index is coming down to test this $190 support region, which so far has been holding up pretty well. And if you guys remember, I charted out both of these support levels in the video I posted this Saturday. And as you guys can see, the RSI is way too overextended to the downside at around 22, which means that we are going to see some sort of relief from this aggressive move we've seen so far in 2022. Now, that might be a big bounce to retest this 208 level, which will definitely result in most of our small cap stocks being up maybe 5, 10, 15% over the next few weeks. Or we could just see a sideways consolidation similar to what we saw happen here. And if we see that sideways consolidation consolidation, which is probably what's going to happen going into the FOMC meeting this week, we should see a potential move to the downside yet again if the fears of inflation continue to hawk the market. And if we get a move below that 190 level, the next support level is around 175 bucks. And I want you guys to really pay attention to this because this is going to result in an excessive amount of selling yet again for small caps, at least if we break below that on high volume. And generally speaking, I don't really expect this market to break below this level. And I think that buyers are going to step in very aggressively because that is exactly what we saw happen during the election time in 2020. Quick update guys, I just filmed the previous portion of this video and it looks like the market has recovered significantly since I filmed that portion, where the market is actually now green instead of red. I mean, look at this, the IWM index, the Russell 2000, is now up 2.4% after being basically flat to red on the day. And that clearly is being represented by this incredible support line that I drew in this weekend's video. If you go down to the weekly time frame, you guys can see that we are bouncing perfectly from that level, which is following my thesis that this market is potentially going to be going sideways or seeing a recovery to at least this 208 area. Although there is no fundamental catalyst that I'm seeing in the market that has pushed these valuations higher, I'm seeing a lot of volume traded in a lot of these stocks that were down well over 15 to 20% at one point in today's trading session, which tells me that right now we're seeing institutional participation in these moves to the upside instead of some retail short squeeze or any sort of random catalyst. Even the SPY is now up by around 0.4% on an insane amount of trading volume, which tells me that this could potentially be a sell-off that was triggered by options expiration from last week. It looks like hedge funds were shorting the market in the morning and gapped the market down very significantly, and that now they've trapped a lot of the people that were shorting the market during the lows of the day for this incredible squeeze. This is a very significant day because as you guys can see, the volume is the highest volume we've had since basically the March 2020 crash 2 years ago. What this tells me is that right now we might be at a short-term inflection point in the market where we're potentially bouncing from this 200-day moving average in yellow. And as you guys can see, the RSI is also at around 28 right now, which is dirt cheap and signals that the pain is potentially going to end at least for the short term. One of my favorite long-term positions, Coinbase, was down almost 15% today after gapping down and now has recovered to basically close green on the day, which yet again signals that you want to take advantage when you see these red days instead of waiting for another red day to happen, because chances are you're not going to nail the bottom and that you're going to miss the boat when the recovery actually starts happening. And it looks like we're starting to see signs of that happening in some of my own favorite long-term growth stocks. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below what you guys are doing in this market and what stocks you guys are watching for some good dip buys right now. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.